She asked for it.
We're gonna spend most of our time on Allison today, but I did want to do a couple things beforehand. One's related to Allison. As you might have seen or remember, naked short selling was brought up again in the chapters we're going to discuss, and we talked about that last time. And so I did a little research on what the naked short is. So we were wrong in what we were speculating what it was. I thought that it was that you didn't have your short covered money-wise. I was thinking money. I don't know if you guys interpreted it different. But basically, you don't have the shares covered. So remember, the part of the kind of important part of the short is that you borrow shares from somebody, and then you sell those shares. So you sold shares that you did not have fully in your possession yet when you made the sale. So after doing quite a bit of looking, I basically ended up on Wikipedia where I got the most information. I went to a couple different sites, and so the Wikipedia information was a little bit questionable, but for our purposes, it addressed what we needed to know about what the naked short is. And so if you look back in your notes, I don't know if you remember where in your notes the short sale is, where we had the short seller borrowing the shares from the broker. So we've got Mr. Short Seller here that is borrowing 100 shares from the broker, who has an inventory of shares that somebody else that's a member of the brokerage had 100 shares in here. Broker has arrangement to make a deal to say, hey, you can borrow these shares for a time period, 3 days, a week, whatever the agreement is, and then those shares as they hope it does. Remember, that's the risk with it. But if the stock falls, they buy those shares back cheaply and replace the 100 shares back into the account. So that's the short sale when it operates the way we explained it. So what the detail that I didn't know is that there's a little bit of wiggle room on the days for which you have to deliver on the borrowing part. It's possible for this person to not actually have the shares acquired and to execute the sale. And so there's a little bit of wiggle room on that, and so that leaves this person naked. In other words, they've committed to having to put back something they don't have because they're legally obligated to pay back those shares which they actually don't have in their possession. And so if they don't replace those shares, they have a failure to deliver. The failure to deliver happens for reasons other than naked short selling. So naked short selling is kind of the explicit intent to do this transaction without having the shares. But in reality, apparently in the brokerage world, stuff that's a little outside of what I've done and been exposed to, is there's this delay time. And so it's very possible for you to execute that transaction without actually perfecting the borrowing. And then everything works out fine if you buy back, like let's say there's a 3-day period on the paying back of the shares. So maybe in 3 days, the share price falls, you buy the shares back at the cheaper price, you got the shares, you put them back, no harm, no foul, right? So you kind of did that same thing within the legal parameters. So naked short selling was not illegal per se. And then in 2008, during the financial crisis, laws were put into place to shorten that window and basically explicitly say you can't do naked short selling. The problem is, just because of the way the fluidity of the market, and there's a lot of shares going in and out and in and out, the SEC can't really monitor that practice very easily. You can't say, hey, you were naked short selling, I've got proof, because it sounds like it's just so complicated with the number of deals that are going on during the day that you can't quite keep track. So you're not totally illegal if you know, committed to this transaction and then there's just this normal delivery time, you know, a transaction time, similar to clearing checks maybe for a bank, right? That there's a day or so to actually work through the accounting of getting from one institution to another. So that's what I learned about short selling. Any questions or comments? Okay. The other quick thing I wanted to do was talk about the impact of short selling. Again, within the Allison chapters and as well as the textbook, why is short selling bad? In other words, do we need or desire government to restrict short selling? You know, what does short selling do for us? We've kind of talked about this, but I found a piece that was kind of interesting in showing this. So imagine we've got a price of a stock over time that fluctuates, and it goes, let's just do kind of a simple little variation where it peaks at point A, it's the trough, if we're thinking about the business cycle for the economy, peak, trough, and another peak here, and a trough here. And so imagine that the blue line represents no short selling. Suppose short selling was illegal. And so let's have the blue line be the no short selling line. If we now allowed short selling, what would it look like? Well, again, if we had a crystal ball, the optimal short sell, the optimal short ex post after the fact, so I'm just kind of giving you an unrealistic example, but suppose a trader would want to sell at A and buy back at B, right? So the optimal short would be to sell at A and buy at the trough B. And similar, we C, buy at D. And so that would be the short selling game, right? We're always just kind of thinking, oh, this plummet. If we allow short selling to enter this market, what do you predict it does to this ride? Tightens it, right? So as we're going up, as the stock's heating up, and maybe it's overheating, so to speak, right? It seems to be a little unrealistic. There's some people in the market that think it's going to continue to go up, but there's now starting to be market participants that fundamentals. I don't think that's going to happen. They start. What happens? Talk to me in terms of supply and demand. Yeah, there's additional supply, right? People are selling the stock, and so that will tend to for the peak. So I'm just going to, again, hypothetically say this, but we might start to soften the blow. Same thing here on the downward momentum. Once they start buying the stock back, buying the stock props the stock price up, right? At a more diffuse volatile. So with short selling, we get kind of less volatility. So the key point is having short sellers causes the peak to be lower and trough to be higher relative to the no short selling picture. creating more volatility. And that's the argument, is that possibly through abuses, they could be driving the stock price lower than what it would be.
Because at the margin, if everybody's selling short, then, you know, if at that point everything drops below B versus stays above.
And so some economists did studies on that, and they found no empirical evidence that that's the case. And so one of the key things, what do we need for that not to be the case? Again, thinking kind of critically about this problem, how do we have a little more comfort thinking that short sellers won't abuse the market, big short sellers won't cause larger fluctuations, more volatility? What do we need? What's kind of a key ingredient to the marketplace to hopefully have that happen? Competition. We're back to competition again. So as long as there's lots of sellers, lots of buyers, each analyzing the market independently, not in cahoots with each other, no cronyism, no big dominant player, as long as we avoid that, then we should get this result. Okay, good. Another just kind of quick comment is that the long positions do the same thing. If we were to flip-flop this and say short selling, which is almost absurd, but the people who are going long on the stock tend to keep this less volatile too, as long as you got both sides of the market playing. So my key conclusion, I guess key number 2, let's call it, having lots of long and short sellers or buyer sellers, whatever, market participants, probably not the best word, creates a more efficient price. And then we're kind of back to efficient market hypothesis type stuff. That having that in the market helps tighten up that price, giving us more or a better feeling that the market price on a given day is approximately appropriate. Right? Okay. Questions or comments? All right, let's talk Allison.